Hello friends, in this video I will explain what you as an investor should look at before buying large cap stocks for your portfolio. Now we have created a list of 7 large cap stocks in our model portfolio so beginner investors can refer to this list and invest. This list of stocks is for a longer term horizon, keeping several fundamental factors in mind. As an investor, this video will guide you to make your own checklist and research these stocks better. Firstly, a brief on large cap stocks. Market regulator SEBI defines large cap as first 100 companies in terms of their market capitalization, which means stocks of those companies that are ranked within top 100 on stock exchange in terms of market capitalization. Large cap stocks make up most of the equity market and generally form the core portfolio of many market participants. India's market-leading indices like BSE, Sensex and Nifty 50 comprises of large cap stocks. Now here are a few signature characteristics which you can look for while researching these large cap companies. Large cap companies are reputed brands with huge size. They have widely used products or services which are easily recognizable. They usually continue to grow or operate profitably even in adverse market conditions due to some moat, either due to their products, pricing or distribution network. And this is one of the reasons these companies are relatively less sensitive to wide market fluctuations in comparison to mid-cap and small-cap companies. Relatively, large-cap companies have strong balance sheet, that is a large number of assets when compared to liabilities, and a healthy income statement, that is revenue and profits continues to grow for the last few decades. These companies have a good past track record of stable growth. But not all large companies will give you the desired returns. Hence, you must pick companies which have a track record of consistently increasing top line and operating margins. They should generally be debt-free companies or operate with low amount of debt levels. It is imperative for an investor to look for operational efficiency in terms of working capital requirement and cash conversion cycle. Investors are advised to avoid large caps with high promoter pledge since it can prove to be risky when the cycle turns. One should prefer large cap companies which have a history of rewarding their shareholders with consistent and increasing dividends. Also, these companies should have high return ratios, that is both return on equity and return on capital employed, should have high interest coverage ratio and ability to consistently generate cash flows. Management's business strategy and the way they steer the company is also an important factor to judge if the company is moving on the right path. Now let's look at a few factors in detail. Firstly, the top line and the bottom line. Now, top line refers to company's revenue, while the bottom line is its profit after tax. It is important to pay attention to them for the signs of any changes from quarter to quarter and year on year. Now, any significant decline should be a red flag, which would need a deeper look. Consistent growth is what an investor should look for. For instance, Tata Consultancy Services, which is the leader among Indian players in the global IT and IT-enabled services, has a top-line CAGR of 10.64% and bottom-line CAGR of 10.85% in the past 5 years, which is considered decent by a large-cap standards. Next is operating profit margin, which is also known as operating income margin, which is a measure of how much profit a company makes after deducting its variable costs of production. A company needs to keep healthy margins in order to pay their fixed obligations such as interest on debt and taxes. A high and improving profit margin is an excellent indicator that a company is being managed well. Now, Hindustan Unilever has consistent operating margins from over the past 5 years and currently stands at 25%. Now moving on to return ratios such as ROE and ROCE. Now both these ratios are used to measure the efficiency with which a company can generate profits. Now these ratios are of utmost importance, which should be compared with industry peers to pick the best bets. The trend of these ratios should be looked at to see if they are improving or not. Now you can see that companies in our model portfolio have clocked healthy return ratios. From the balance sheet, you can check a company's debt to equity ratio. It helps to determine how company finances its assets. Now too much debt can pose risk to company since the cash flow will be used to meet the debt obligation instead of reinvesting in the company itself. It is seen that all stocks in our model portfolio have no or low levels of debt. These companies will enjoy a higher valuation when compared to highly indebted ones since they'll be able to conserve cash and reinvest instead of paying the fixed obligation interest. Now these cash reserves will help them to fight against uncertain and unprecedented times like the current situation. This is the sole reason why large cap companies have survived a number of bear phases, market crises, and financial troubles and are still going strong. Coming on to valuations, EV upon EBITDA is a popular valuation matrix to compare the value of a company to its industry peers. The comparison of relative value among companies within the same industry is the best way for investors to determine if a price they are paying for a stock is more than its fair value or lower. Now, these ratios can also help in understanding if a stock is overpriced, fairly priced, or underpriced relative to the company's true money-making potential in the same industry. Let's look at our model portfolio. Now you can see that Asian Paints, which is the dominant player with a share of over 50% in organized domestic paint market, seems overpriced when compared to others, whereas ITC has the lowest EV to EBITDA ratio. Next is dividend yield. As discussed, large cap companies are known for rewarding their loyal shareholders with consistent and increasing dividends. Now, dividends are a portion of company's profit that are distributed to the shareholders. It is important for an investor to find out if a large cap company is consistent and is increasing the dividend over a period of time. Take a look at our model portfolio. Each company pays a good amount of dividend yield. ITC has the highest dividend yield of 5.19% when compared to other large cap players in our model portfolio. Now, amongst blue chip banks, Kotak Mahindra Bank stands out on all parameters. The bank is superior on all fronts, namely profitability, net interest margins, controlled formation of bad loans, that is non-performing asset, low cost of deposits, that is the CASA deposit, provision coverage ratio, and last but not the least, sufficient liquidity to cushion the balance sheet during uncertain times when compared to other blue chip banks. Now, if you want to know more about how to analyze banks, please check out our the best banking stocks to buy video for detailed explanation. Now, given the uncertainty in the broader markets, investor has shifted the focus to safer havens such as large cap stocks. Now, large cap stocks are considered to be relatively safe stocks and have well analyzed track records, thus making them less volatile. Since these companies are already mature and have comparatively lesser capex needs, money is usually returned to the shareholders through dividends, which is considered as a boon during such uncertain times. Therefore, an investor's portion should always be allocated to large caps in order to cushion their portfolio during difficult times. Thank you.